Hello again. This is the last video on midterm review covering Chapter 18. Again, referring to the Word document that was attached in the Week 4 folder that provides a summary review for the exam under Chapter 18, which is the chapter on cost, volume, profit. Knowing how the typical types of costs tend to behave over a relevant range, that is fixed costs, variable costs, and mixed costs. The high-low method of breaking down a mixed cost into its fixed and variable components. The concept of contribution margin and what it means and how it is computed, and understanding the break-even point and where this falls in terms of sales, fixed costs, and variable costs. So we're going to focus in this problem on the last couple of bullets. Time doesn't permit going through each and every thing here, but that's why I'd encourage you to use the discussion board to talk over with others things you might be having problems with, and I can jump in there, and certainly send me an email if you have a specific question that you want to handle off the discussion board, whatever the case may be. Now, going to the example here for Chapter 18, which is the Decision Toolkit problem on page 965. And of course, you can look at this at your leisure and see the solution that's provided as well, but I think it's valuable for us to walk through this one step at a time. So in Part A, they're asking you to compute the operating income for the period with information given on sales and variable costs and fixed costs. First of all, the sales were given as 20,000 units sold at $25 selling price apiece. When you multiply those two figures together, you get sales of 500,000. Our variable costs were identified as $15 per unit. We know that we have sales of 20,000 units, so the variable cost would be 20,000 times 15, or 300,000. And the fixed costs were given as 135,000. So when you subtract the variable costs from the sales, first of all, and I didn't show it here, you would get a contribution margin of $200,000, right? That comes from what we've learned in the chapter. Then when we subtract the fixed costs, we get an operating income of $65,000. So that's Part A. Part B is asking for the contribution margin per unit. It's simply the selling price per unit of 25 minus the variable cost per unit of 15 gives us a contribution margin dollars per unit of $10. Now a little bit later we'll be looking at the contribution margin ratio, but in Part C they're asking for a break-even point in units, and in order to compute that you need to know the contribution margin per unit. You're going to be dividing that into the fixed cost total. So showing the formula here, the fixed cost of 135,000 divided by the contribution margin per unit of $10 per unit gives us a break-even point in units of 13,500. So everybody hopefully with so far. Then we go to Part D, in which they want you to compute a break-even point in dollars, and in this case the business owner has stated that he would like to increase, I think it was advertising expenses, $10,000. That's a fixed cost, which means the fixed cost will go from $135,000 to $145,000 a year. And in order to get the break-even point in dollars, you need to use the contribution margin ratio, not the contribution margin per unit. Big difference there. So first of all, we would need to compute the contribution margin ratio, which I'm showing down at the very bottom here, as 0.4, which is the result of dividing contribution margin per unit of 10 divided by selling price of 25. Okay, so everybody with on that, hopefully. So then when we compute the contribution margin ratio, we can use it to solve this problem for a break-even point in dollars of 145,000 fixed cost divided by that 0.40 contribution margin ratio to give us a break-even point in sales dollars of 362,500. So, and you know, you can see the reasonableness of this by going back to A and seeing that we made an operating income of $65,000 on sales of 20,000 units. So you would hope that even with that increase in fixed cost, that you would not need to sell anywhere near 500,000 to break even. And this shows that you need to sell 362,500 worth of sales in order to break even. All right, so that's A through D, and we'll wrap up with part E here, which is asking for the required sales dollars in order to make that same amount of operating income with the increase in fixed costs from 135 to 145,000. So again, you need to use the contribution margin ratio because we're talking about computing the required sales dollars, not units. Okay, so contribution margin ratio goes with sales dollars. Contribution margin per unit goes with computing a break-even or a required number of units to be sold. So that's how you can keep those straight, hopefully. Now, back to this. We have a desired or target income of $65,000 from the previous case in Part A. And we know the fixed costs are now going to be $145,000. So we need to take the fixed costs, add the target income of $65,000, and divide that sum by our contribution margin ratio of 0.4. So when we do that, we end up with an answer of $525,000. That's what it's going to take in sales in order to generate an operating income of $65,000. And again, comparing this to Part A of the problem, where we had sales of $500,000, but we only had $135,000 of fixed costs, means that we need to sell $25,000 more, basically, to make that same operating income. And when you think about that, when we sell $525,000 of the product, our variable costs are obviously going to go up somewhat as well because our selling price didn't change. So that's another reason why, with the increase in fixed costs, that we have to sell this amount in order to still generate the $65,000. And you can go through there and do that calculation on your own to prove that out. So with that, that's the wrap up of Chapter 18. And again, feel free to use the discussion board or the email for any further questions on the midterm exam.